In the spirit of keeping your ear to the ground about what's going on in the mortgage business, you might have heard that Eric Bowlby is relaunching AmeriFirst Financial. His goal is to bring broker pricing with banking products and service. Now, we had a candid conversation about what's important going forward and the changes to the mortgage market and how it pertains to and will affect mortgage loan officers. With that said, enjoy.
You know, the mortgage world, in my opinion, for the last year has been broken. In fact, I just got back from the National Secondary Conference. I was speaking to every major investor who I sell loans to. So you're talking the big guys, Penny Mac, AmeriHome, all the big players. And I would ask the question, how many mortgage companies made money quarter four, quarter one? The largest number I got, which was from Penny Mac, largest correspondent lender in America now that Wells Fargo's left, 3. That's it. 3 other people. So there's obviously an issue. Part of the issue is rates are up, people are not sure if they want to buy, and that's driving the value of a mortgage. And we've basically seen between 100 basis points and 200 basis points disappear depending on what type of loan it is. And the reason it's disappeared is when you're looking at servicing values of loans. On a Fannie Mae, the typical value you get for selling servicing rights is a 4 multiple. So a 4 multiple is 100 basis points or 1% of the loan. And on a Ginnie Mae, same 4 years, but their value is 0.5%. So 200 basis points. The reason why this is important is because it messes up the math of everything that's been going on in the mortgage world. I'm going to say for the last 15 years. For the last 15 years has been a big push. I'm not going to pick on anybody, but I can probably say it and you guys can figure out who I'm talking about. When you start going to coaches, mortgage coaches telling you how you should run your business, they were telling you should have a 4 loans for every 1 person on your team. And so every originator or top originator started looking at the business and going, I can't afford to split my commission with a 4-to-1 ratio. So I now need to go get a branch model. And every top originator started going out and getting branches. And so it used to be in the mortgage space, a branch manager, when I say used to be, I'm going to talk previous crash, pre-2007. A manager did 3 things. They recruited you to come work for them. They would close your transactions and they would retain you. And the way that most managers retained you back then is they went out, they helped you grow your business. They were kind of coaches. They were the people who had maybe been in the business for 20 years. They were tired but they still had an industry knowledge that could really make you better than you were. And they could help you get more agents. Then it switched to be more about teams and teams becoming branch managers. And then people who had previously been branch managers, then they would step it up and they'd become regional. So every time somebody decided they want to move up the food chain, somebody else had to move up the food chain as well. You were a branch manager. Now your people that you trained and got there, they want to be branch managers. So you have to jump into a regional spot. And then you have to help all your old originators become branch managers. And that's gone on and on and on. And it was okay when you could sell a loan in the market and get 400, 500 basis points on a loan, but you can't today. The max today is right around 275 to 325. Well, the problem is most of these branch models were built around a 250 to a 300 margin rate sheet. Then you had a region margin, and most regionals were trying to hold between 25 and 50. And then you had corporate margins who were trying to hold 50 or 75. And when you just do that math, it's a problem. It's all about the originator. If you were previously a branch manager and you were making your money off of 5, 10, 15 loan officers who worked underneath you, and you were also doing your own loans, and my personal opinion, those days are gone, at least for now. It's cyclical. The mortgage world changes all the time. But right now, if you're not a skinny rate sheet with a skinny overhead, you can't compete, because there's a ton of people who are sitting in their Huggies in their parents' basement that'll do a loan to make 50 basis points. And if you still think you're worth 150 and your branch is worth 300 and your region's worth 50 and your corporate's worth 50, you have a math problem, and that math problem is real. So for me, the mortgage industry is going back to where when I first got in it. When I first got in it, banks had lean margins. It wasn't like it is today. So you got to have a lean margin where corporate is really the branch. right? It's going to be about originators. If you're doing 2 or 3 or 4 deals a month, you probably could be doing 6, 7, or 8 if you had better rates. What I hear constantly from loan officers is they're losing between 25 and 40% of their volume because they can't match the rate that some online lender is offering. The difference of 50 basis points today, 50 basis points a year ago was the difference of 0.25% of interest. 50 basis points today is 0.5% of interest. So if you're out 50 basis points, you're out 0.5%. And that is enough to get a customer to leave you. You can hold on to them if you're 1/8% or 0.25%, you can hold on to that customer. But if you're 0.5%, if you're 0.75% out, you're not holding that customer. It could be your best friend. It could be your brother. It could be your sister. That's an affordability problem because prices are still high, rates are high. That 0.5% might be the difference of whether a person is willing to buy the house or not. So you've got to be aligned with that. The second part is, what are you doing to attract buyers? Right now, my biggest fear, and I've got an answer to what I'm doing. I won't give all my secrets out, but I think we have to get to where we're getting to the consumer before they even think they're in the market. Because as soon as they're in the market, where are they going? They're going online, they say houses for sale, and they end up at one of 4 places: Zillow, Redfin, Trulia, Realtor.com. And then once it gets to one of those 4, or maybe all of those 4, it then gets sold to 30 other mortgage companies and everybody's chasing it. Then you have people who all they're doing is buying trigger leads right now. And they go, well, I don't know how to find a borrower. I'm going to wait till somebody else finds them. And then I'm going to cold call them and I'm just going to be the discount guy. I'm going to do it for cheaper than anybody else would do. They work, right? There's plenty of people who make a living off of Zillow. There's plenty of people who make a living off of trigger leads. But people are getting smarter. You can now do soft pulls on credit. I know loan officers who do a soft pull. They don't even run the final credit report or a hard pull until the loan's at docs. And they do that so when the guy calls and says, I can do it for 0.5% cheaper, they're like, yeah, but I'm signing tomorrow. I don't have the time. And so people will adapt. But to me, it's about sharp rate and then how do you get to the consumer before they're ready to buy? And be that loan officer who not only has a good rate, has good service, because good rate without service sucks. If you can't get your docs to title on time or early, you're going to lose your business. But then the next thing is you got to be that loan officer who's handing deals out. I promise you, if you're not getting good at getting your own deals, trading with agents, the LOs who do that, they're taking your agent. I don't care who you think your agents are today. Your agent, who, let's just say the average good agent does 2 to 4 transactions a year. So if I come in, or another loan officer that comes in that has their own deals and says, you're doing 2 to 4, I'll give you 1, but I want your other 2 to 4. They're switching. They have to. It's a math problem for you again. I'm going to find the people who don't know they want to buy a house, and I'm going to show them why they need to be homeowners, why they need to act now, and why they don't want to continue to wait. Do you know you only have to call 100, make 100 cold calls a day? You will get a 1% close ratio. I promise you, I've done it for years. You can close anything at 1%. If you're not doing a deal a day, it's because you're not willing to get on the phone, or it's because when you get on the phone, you don't sound right, and you get what I call sales mouth. I like to quote The Wolf of Wall Street. It's my favorite sales movie of all time. I know it's got some craziness in it, but he has a phrase where he says, if you will just say the words that I teach you, you'll become rich. It is that same way. If you follow the words that I give you, you can convert and close 1 person a day. Just make 100 phone calls. How much do you care about your wife, your kids, or whatever it is? Maybe it's your dogs. Maybe it's the hobbies that you love. Whatever it is, are you willing to take 99 no's to become wealthy? And if you will, if you're willing to do it, now you need a coach who can show you how to do it. And there's a lot of them out there. I'm not saying I'm the only one. There's plenty of coaches out there that'll teach you how to sell. But you need to get very good at getting your own buyers, and you better have a rate sheet to hold on to. Because as soon as you pull credit, the trigger guys that are sitting in their Huggies in their parents' basement, they're going to call them and offer them a smoking a sweet deal. You need to be within 0.25%. 0.25% you can always sell. Half you can't.
I hope you guys found this helpful. If you have any questions, story ideas, or scenarios that you'd like to share with us, feel free to reach out anytime. With that said, I look forward to seeing you on our next video. Thank you.